It's the Singapore budget season again. With all eyes on the goal of smart nation and a vibrant future economy, we're all waiting to find out what fiscal changes the upcoming 2018 Singapore budget announcement will put forth to propel the country forward. What can we expect in this year's budget? Here are the top 3 fiscal changes on our wish list. Number 3. Tax concession for training and to help companies go digital. It's not cheap to digitize a brick-and-mortar business and upskill employees. Right now, companies can enjoy reliefs and cash payout under the Productivity and Innovation Credit Scheme, the PIC scheme in short, when they invest in innovation and in increasing productivity. This makes it more affordable to go digital. However, with the expiry of the PIC scheme, companies, especially startups, will need to cope with the cost of going digital. And this includes the cost of training employees to be fit for the future. With this in mind, we'd like to see targeted reliefs to help alleviate investment costs for companies at the crossroads of going digital, and also a double deduction for training costs. Number 2. Enhanced writing down allowance for the acquisition of intellectual property. Intellectual property, or IP, underpins the growth of modern economies today. Although Singapore is already an attractive location to hold IP, sometimes legal and commercial reasons prevent MNCs from transferring ownership of their IPs to Singapore. That means both legal and economic ownership. If only the economic ownership is transferred to Singapore, approval from the Economic Development Board, or the EDB, is needed for tax allowance claim. To encourage more businesses to transfer their IP ownership to Singapore, we hope that the writing down allowances will be automatically given to the economic owner of the IP in Singapore, removing the need to go through the EDB. Number 1. Enhanced deduction for R&D activities with nexus to Singapore. The strength of a world-class innovation hub, which Singapore aspires to be, lies in its R&D capabilities. With the expiry of the PIC scheme, businesses that carry out their R&D activities overseas are no longer able to enjoy enhanced deductions. However, there are certain aspects of R&D that cannot be carried out in Singapore. For example, inadequate sample size and geographical constraints. By necessity, these activities have to be conducted overseas. In the borderless world, there is a need to recognize the importance of overseas R&D to Singapore's innovation ecosystem. We'd like to see the further deductions extended to qualifying R&D activities conducted overseas, so long as these activities have a nexus to the Singapore business, such as the IP developed out of the R&D will be owned by a Singapore resident enterprise. We also hope that a minimum of 200% enhanced tax deduction will be given to qualifying R&D expenditures when the PIC scheme expires. Otherwise, our regime is not competitive on a global stage. These are the top 3 fiscal changes we'd like to see in this year's budget announcement. Are these on your wish list too? Leave a comment and let us know what you think.